Good.
Okay,
All right. So we're gonna go ahead and get this thing started.
let's
Um,
roll. Let's roll.
do it as always. I'm Confessions of a Black Female Investor. I have a guest today, Mr. Mark Chambers.
What's
We'll
happening? What's happening?
Hey, Mark. We'll get into discussing things with Mark in a little bit. But first, as always, I'm going to do the disclaimer just to make sure that we are covered. All of the content I share today is for educational and informational purposes only and is based on our experiences. Investing in the stock market always comes with risk. Please do your own research or consult with a licensed financial advisor, tax professional, or other qualified expert before making any investment decisions. As always, this is a safe space. We're all here to learn. I encourage vulnerability and kindness. So ask questions, take notes, and let's share the information and make sure it gets out there in our community. So, Mark, we'll go ahead and just jump this off with a little intro about you. Can you just tell me a little bit about your investing background?
Yeah, it's not very extensive. Well, you can say it. I started in about 2017, really messing around with stocks. Some of my coworkers introduced me to Robinhood, and on Robinhood, I started buying and selling some crypto and some just some any and every stock I could. Just thinking, hey, I might if I can win on here, and $5 here, $10 there, and then I kind of let it go for a while, and then in 2018, 2019 actually, I became self-employed, and so I started thinking on what I needed to do to fill in the void that I no longer had 401k or anything like that I was investing in. So I knew I needed to do something to take care of my future. And so that's what led me back to investing. And so in 2021, I got back into investing, not in the right way, but, you make some mistakes, you learn along the way. And so over the period of time, I've just learned a lot of things. I'm a numbers person. So when you started talking about numbers and looking into the evaluation of companies and things like that, I just started to get more and more intrigued by that stuff. And so it just kind of evolved from there. So
Okay. Yeah, that's good. And so you've been consistent with it for the past couple years.
Since about 2022 is
Okay.
when 2022 when I became consistent.
Okay, that's a great time. I mean, the market was really, down with COVID. And I think that's when a lot of people got into investing, specifically Black people. I think younger people also, there was, with the stimulus, there was a lot of money floating around. And so
yeah, they were throwing money around, boy.
Yeah, I think that's when people started really looking into this thing called investing, and with the market being down, seeing what it can do. So you said win. I thought that was funny earlier on, and you said, to see if I can win, because a lot of people, that's what kind of deters them from the stock market, is they think it is gambling. And so I'm a big person to say, no, it's not, it's not. And so can you just speak to that a little bit more?
Yeah. So when I first started, it was really about, okay, if I buy this stock today, can I make a profit and be able to pull that profit out in about a week or 2 weeks? So I was really looking to make short-term gains over a extended period of time. But what I found out is it's hard to, it's especially on the short term, it's hard to be a consistent winner, especially when you're a novice. You don't know how to evaluate what's a healthy company, what's a profitable company, what's a company that's on the rise, and so I was just really throwing a lot of stuff up against the board and see if anything would stick, but nothing was really sticking.
Yeah, no, I think a lot of people do that. Somebody tells them, like you say, you get on Robinhood, they give you those free stocks, and everybody want it to work out, right? They want it to work out overnight, not realizing, that's it's a big conversation, certainly, but not realizing even just the tax implications of, if that stock were to strike overnight, and you want to pull that money out, or if it's just a small capital gains, you're looking at pulling that out within the next month, 2 months, you are going to be hit if you are, not in a tax advantage account, which is what most people are going to be utilizing, is that brokerage, taxable brokerage.
And it was funny because I didn't even know what day trading was. And I was trading so frequently, trying to get these. I got flagged as a day trader, and I was like, "What is that? What is that?" And so I was like, "Well, maybe I'm not doing something. Maybe I'm doing something wrong." And so I had to put things on hold for a while until I started to figure out a little bit more about what I was doing.
Yeah, Robinhood doesn't play. You get those 3, and they are on you for definitely for being a day trader. So so now you're more of an investor, and you're looking at the long term, and that I think is also one of those things that deter people is the long term, right? How long are you holding stocks for? And the average retail investor, how long do you think, is a good period?
So as I started to transition from trading to investing, I started, reading and educating myself about what we really was investing about. And one of the quotes that really stuck with me was Warren Buffett. He said that he plans on holding when he invests in a company, his plan is to invest it until he dies or he finds something better. And so that is kind of the philosophy I started to develop. And so that led me to really want to deep dive into understanding why I want to hold a company for a long time, making sure these companies were healthy, making sure these companies were profitable, making sure these companies were seeing, increases in their revenue and things like that. So that led me to understanding, evaluating companies, because if I wanted to hold a company for a long time, I better understand if it's doing well. I better understand the ins and outs of this company. So that led me to learning how to evaluate companies. And so now my plan when I buy a stock is to hold it until it no longer meets the criteria that I kind of developed over a period of time. I monitor all of the stocks I hold in my portfolio pretty regularly. And so over the period of time, I developed some specific criteria as to what kind of stocks I want to hold. And so even though the market might fluctuate up and down, as long as they continue to meet the criteria that I picked them under, I'll just hold them and continue to dollar cost average into them. And so my plan is to hold a quality company, just to keep investing in a quality company until that company no longer is quality.
Yeah, good. I mean, that's a good strategy. And anything that Warren Buffett does, we know it's probably going to be successful. So yeah, I definitely agree with that. So dollar cost averaging, one of my favorite ways to invest. I think it's a good segue to, how the misconception that people think you need so much money to invest in the stock market. And you don't, you absolutely don't. Dollar cost averaging is a strategy for people that don't know of continuing to invest a set amount of money. So whether that's $20 or whether that's $50 each week, you invest that same amount into the market, and then you buy regardless of what the market is doing. So, for example, if you're putting that $20 and stock is trading at $10, you're going to get 2 shares. Next week, if it goes up, or in a month, if it goes up to $20, you're going to get 1 share. So you're continuing regardless of what the market is doing. So dollar cost averaging.
And that conviction from for being able to consistently buy into that company comes from understanding the fundamentals, understanding how the company creates its cash flow, how the company creates its revenue, That's how you create that confidence. So you know, okay, this stock has over the last month, it's gone down about 2%, 3%, or whatever the case may be. But I'm confident buying it 2% lower than I bought it last month because I know that in the long run it's going to benefit. You know what I mean? So that
Yeah.
confidence comes from knowing this is a good company. Yes, it might have some ups and downs along the road, but its history has proven that it knows how to weather the storm, and it
Yep.
always makes adjustments.
Yeah, absolutely. I always, when I'm working with clients, we're looking at 5-year charts at least. We
Yes,
want to
absolutely.
at least 5-year charts to see what a stock has done over time. And that's another thing that I consistently encourage my clients. You're not looking at your portfolio every day. Let's get everything automated, and especially your retirement portfolio.
Yep.
It's going to go up, it's going to go down. That's part of the process. And so just making sure that you're prepared on the sideline with extra capital, when it does hit that price. And like
Yep.
you said, it's 2% down. If you loved it when it was 20% up, you should really love it when it's 2% down. Buy
Absolutely.
more. Buy
Absolutely.
more.
I always consider a down day. That's when stocks are on sale.
Yep.
That's the disc. Get it out of this. Matter of fact, when one of the biggest, best times so far over the last 6 months was March, April. When everything tanked.
Yeah.
Oh my goodness.
Yeah.
And here's a quote I remember. Oddly enough, it's from Warren Buffett also. But he said, when you become fearful when people are greedy, but you become greedy when people are fearful.
Yes.
And so it didn't make sense until March, April came and everything was really making a massive tank. I'm like, these are still good companies, man. I'm not selling this stuff. I'm buying this stuff. And so I bought as much as my money would allow. I bought as much as I could, and as a result, I've seen some massive returns by focusing not so much on when the stocks were up, by focusing on when they were down.
Yeah, yep, exactly. You want to get them on sale. And it's really crazy though, because like when you think about going into a store, and people love to see a sale. Right? They love to see a sale. They're going to stock up on it, whether it's groceries, whether it's clothes, whether it's their favorite item. But they don't have that same philosophy when it comes to stocks. Have you noticed that?
Right.
When we see stocks go on sale, they don't see it as a sale. They see it as the company is no good, is plummeting, but they don't have that same conviction when it comes to, just basic retail.
Yep. And that's why I think understanding the fundamentals of the company was so important for me, because now I don't really worry about market fluctuations, because everything I'm confident in everything I'm holding in my portfolio, and so I don't really worry about it.
Yeah, that's a good point. And even if you don't, so, a lot of the reason I think a lot of new investors get scared about the market is they don't know what's going on. And Warren Buffett, another one of his famous quotes are, you don't buy anything you don't understand. You don't invest in anything you don't understand. And so the stock market, the full landscape of the stock market, when you start thinking about fundamental analysis, technical analysis, income statements, and those things can be overwhelming, right? So in terms of, a new investor not looking, maybe not ready for fundamental analysis and ready to take that next step, but still understanding that they need to invest, what would be your messaging to them?
So for one, I would, if you want to start, I would start with something that would give you a lot of safety with little risk, like ETFs, or in the I think mutual funds are pretty much along the same line. But mutual funds are typically a little bit more expensive. ETFs, the average Joe can get with fractional shares and things like that. But ETFs, because they typically an ETF that follows the S&P 500, like BOO or SPY, or I think IVV is another one that follows the S&P 500. Just because in that ETF, you're going to own over 500 of the country's top companies. And so it diversifies, it gives you a lot less risk, because one company is not going to massively impact that whole investment. So you, instead of investing in one company, you can have some real confidence in investing in 500 companies at once. All of the top companies, Apple, Microsoft, I mean, you name it, it's in the S&P 500. And
Right.
it's one of the easiest, most, I believe, painless, more reliable ways of having long-term success in the market, because the market has proven it's consistently increased over time. And so just by being exposed to the S&P 500, you're going to see increase.
I agree. I think the S&P 500 for new investors, when you talk about an ETF, which is a basket of stocks. So, it's a really fancy way of getting, or a really simplified way, I should say, of getting access to the top companies without having to take on the risk of just loading up your portfolio with the apples of the NVIDIAs. Now, obviously, you're not going to have that growth, but when you're just looking to get your feet wet, the last thing you want to do is be soured, on investing.
See, and here is the difference. Here is the difference between somebody who's not comfortable with investing. It's a mindset thing. It's a mindset thing. You really have to see it as what's the I lost my train of thought. That happens frequently, because I always got about 500 thoughts going at once. But you really have to change the way you see the association with money. It's a psychological thing. But here's security. People who have worked 30 years at one job, or they are comfortable working a 9 to 5 because they like that security, and investing in a ETF, especially a S&P 500 based ETF, is one of the most secure ways of investing with very little risk.
Yeah, absolutely. And you nailed it. And Ashley Marie put in the comments, the mindset is something you talk about in your book. And I do. In my ebook, Beyond the Bag, Investing in Wealth Strategies for Black Women, I devote a whole chapter in really encouraging and developing a really strong money mindset, because nothing is going to move the needle until you get a hold of that mindset, until you understand why you treat your money the way you do, how you allow your money to treat you, how you understand making money, and what your long-term goals are in terms, like, all those things have to be unpacked before you really start, because I think most people are operating from this very short-term perspective.
Yes, absolutely.
And they want to, show their money rather than allow their money to show them something, right? So once you, get into investing and really start to see that growth, I think it's almost impossible not to want to do it more.
Absolutely. And that's what happened with me, because once I started getting past the growth phase of making bad selections and trying to recover from those bad choices I made at the beginning. Once I actually made the corrections, or started to replace some of those bad choices and started to see my portfolio go up, I started to have a different mindset about how I spent my money and how everything about because I started to see, okay, is this going to benefit me in the long run, or is this a waste of money? Because if not, I can put this in my portfolio. You know what I mean? So
yeah, it's a paradigm shift, for sure.
I mean, it was a massive shift. You know, I don't really concern myself with trying to keep up with trends, and you know I mean, I sacrifice some things because I'm trying to benefit me in the future rather than taking all of the enjoyment right now.
Right. Yeah. I'm the same way. I think of everything in terms of, you know, the value of a stock. Like I used to be a big tennis shoe fan. I was a huge tennis shoe fan. But now I look, even though I wear kids sizes, there's no way I can go out and spend $200 because I'm like, that's a share of NVIDIA.
Yeah, absolutely. Yep.
I can't go out and spend $200 on a pair of shoes.
Yep.
And I don't want to. I really don't want to. And that's just like, I can look at them and appreciate them. But when it comes to my actual, okay, this is what I want my money to be doing for me. And this is how I want to treat my money. I say that often because I do. I feel like it's a relationship, and how you treat your money determines what it brings you back, you know, like any relationship.
And it's not as much about how much money you make. It's about how much money you can keep. And how much you can get that money to work for you.
Right. And that's the thing. I think a lot of people don't understand, you know, one of the other things I talk about in my book is just people believe that trading time for money is the answer. Well, I'll go out and get a second job. All right, I'll just make more money. No, you need your money to make money. You know,
absolutely.
The goal is to buy you freedom. It is to buy your time back. And so, you know, just look at this AI boom. The reason it is so effective is because it's buying people time back, right? Yep. Like that is the bottom line. It's
one of my best. I think you said something when we had some discussion earlier about your portfolio being very tech heavy. So is mine, but so is the S&P 500 at the top of the S&P 500. The heaviest weighted sector in the S&P 500 is the tech sector, and it's just the way everything is going. It's just the way, you just can't get around it.
Exactly. Well, and not to mention, so you've got the tech sector, but then you've got, you know, the healthcare industry being impacted by the tech sector. Mm-hmm. So now it's touching every avenue. So it's not just the sector.
The energy sector also.
Yeah. The energy sector is insane. Yeah, exactly. Yeah. And definitely some sleeper stocks in there too, you know, that when you talk about these grids and what it's going to take, you know, to power some of this stuff, like all of that is factored into it, right? Mm-hmm. And I think that's a great segue to kind of, you know, how people determine like what you're picking when you're picking stocks. Because like I said, if you're not into fundamental analysis and you're not into taking that deep dive, what are you into, right? Mm-hmm. What are you into? You're into your phone. Who makes your phone? Apple, Google, right? Mm-hmm. You're walking around with your AirPods. You know what I mean? You're investing in the product line so much. So it's like, why would you not own the company that makes these things?
That is probably the easiest way to start. Where do you spend your money?
Yep.
Where do you spend your money?
Yeah, think about it. If you really think about it, Dick's Sporting Goods is another stock that I've had that I got some decent returns on. And it's taken over, right? You know, it's the shoe stores or the JDs and Finish Line is a non-existent. Those things don't matter anymore. You go to Dick's for the one-stop shop. And their stock has had consistent returns over the past year. And you see, you know, they've got every brand in there. They're hitting you from every side. Mm-hmm. And people it's consistently packed. They're building new stores every other day. So it's like, why would I not invest in that company? And I think that's part of the mindset shift we have to go through. It's like, we got to go from, oh, everybody's getting that to I want it to no. I want to be selling that.
Yeah. When I read the cash flow quadrant, and it talks about the different ways people make money. You have people on the left side of the quadrant that mostly work for their money, and then you have people on the right side of the quadrant that typically has either other people or their money working for them. Mm-hmm. And so the biggest thing, like it was talking about how it's better to not be the employee or the business, but it's better to own the business.
Yeah, absolutely. I mean,
so yeah, the employees might do good, and you might do good if you work in the business, but the business owner is doing better.
Yeah, you're never going to do as good as the CEO or the owner. Yeah, you're never gonna do, you know. So, you look at the shares that Mark Zuckerberg owns of Facebook, like, you know, when his dividend hits, like and not to, but also to like really speak to taking Mark Zuckerberg, right? So I think he gets $2.7 billion in dividend off of Meta.
And Buffett gets some insane amount of dividends from Coca-Cola.
Right.
I mean, right. Yeah, that's crazy.
But talking about like Meta, that is, you know, him, Elon, Jensen, like they own their company and their net worth is tied into that. You think they're going to let those companies fall?
Absolutely not.
Think about that. They get 2.4 billion in dividends for owning trillions of shares.
Mm-hmm.
They're not going to let that company fall.
Which that leads me to something else. When I started to transition my mindset about the things that I was investing in, one of the things that I wanted to make sure of was I don't have almost everything in my portfolio is mega cap companies. So they're companies that have a huge bite of the market, who have been around for a long time. They've weathered the storm. They know how to handle different financial climates, which also adds to them being successful over long periods of time. So when I look at investing in a company, one of the first things I want to see, are they a large company? Have they been around for a long time? Have they consistently been making profits? How do they make their profits? You know, those type of things, because I feel more confident investing in a Apple who has a couple $1 trillion market cap versus some startup phone company, if that makes sense. Absolutely. You know what I mean?
It's a proven record. I mean, it's no different again, you know, looking at the history and being able to say, okay, I know that this, you know, may have some pullback, but I know for the long term, this is a good company.
Yes.
So, you know, I feel like some of the things that we're talking about here are really basic, right? It's really like just easy. Like, so why do you think Black people aren't investing in the way that we would have them?
Fear of the unknown, because not enough of us have enough extensive experience in that space. And so because of that, we don't have that many role models, so to speak, or mentors that we grow up with who we can pattern ourselves after. Man, that old dude, man, he's been rocking in the market since I was a little boy, man. And you know, so we don't have those types of examples. Right. So therefore we don't get exposed to that. And so it's people like you and you know, myself on a smaller scale that just have to encourage people to educate themselves about it, and to not be so fearful of it. It's taking a risk, but you take risks with everything, you know, and you can't ever move forward always staying in a comfortable box.
Yeah.
Comfort is the enemy of progress. And as long as you stay comfortable, you'll never progress.
Agreed. Yeah, I think fear is certainly a big part of it. And then you hit another point. role models. We didn't have these conversations growing up. We
Nope.
didn't have, well, even today, right? If you turn on MSNBC and you turn on Squawk Box, you turn on CNN, the people that are discussing finance don't look like us. They don't talk like us. You may every once in a while have a Black man come on. Very rare that you see a Black woman. But you may see, a Black man come on the show, and shout out to Frank at CNBC, because he was one of the people that I felt, okay, he talks like me, and I like him, and he's talking about stocks and our culture, and so I'm gonna follow that. But you don't see it a lot. You don't have a lot of people out there that look like us. And our conversations, sadly enough, are rooted in, financial trauma and, everything that Black people have endured, especially when it comes from the ownership front and, being able to own, whether it be houses or, invest in the stock market. The conversations have not been there in our community.
100% agree. 100% agree.
Yeah, and it's a challenge because
you're a product of your environment. So if nobody's talking about financial security, if nobody's talking about financial freedom, you're not going to talk about it, and therefore you're not going to be exposed to those things that would help you accomplish those things.
Right, and you can't model it. So yeah, I agree. I think that's certainly part of it. And then I think just the education, just being enlightened is a big piece of it.
Yep. I think too, getting away from, but this is not just a our culture issue. I think it's it's just a society issue, but getting away from the instant gratification mindset.
Yes.
Getting away. I mean, the amount of dopamine hits that people get from their phone has just created monsters. I mean, you everything is about, I need it right now. And so if investing is not a right now game. And so because of that, that's another reason why I think a lot of people in general, and us particularly, stay away from it, because I won't be able to see any tangible results next week or next month. It's going to take me. It's going to take me years to actually see the fruits of this, and we don't have that forward thinking mindset on a whole.
I agree, and I think it has to be part of that mindset shift. Right? Is it has to be transferable, because you're operating that way in another aspect. If you go to work every day and you contribute to your 401k, you're already dollar cost averaging and you're already investing, right? You're already doing these two things. So it really shouldn't be a large leap to do it on your own, because I got news for the people. Your employer isn't, acting as your financial advisor. They are not rebalancing your portfolio. They're not, so what you're getting out of that, and the taxes is a whole nother conversation, but what you're getting out of that is very, very, like, bare minimum passive.
It's basically a glorified savings account.
Absolutely.
It's a glorified savings account, because the average person cannot, if you ask them, okay, is your 401k, is it outperforming the S&P 500? I don't know. Is it, what's your year-to-date return? I don't know. What kind of securities are you invested in? I don't know. So it's it's just a shot in the dark. I'm just going to keep throwing this money into this place just passively, and hope when I get done working, it's going to be enough for me to survive on. That's not a way. That's not a good plan, in my opinion. Right. I mean, it's a start, but it's not a good plan if you think that's going to be sustainable in the future.
Agreed. And that's another chapter that I hit in my book is those 401ks. I have a checklist in there because there's so many things that people are just going to work and they're contributing to this plan, contribute to this plan. They have no idea what type of returns. They have no idea what type of fees they're paying. And then also the 401k is not all bad because that's when you talk about investing, that's where real wealth is built.
No, it's not a bad thing at all. No, I'm not trying to say it's a bad thing.
No. Yeah. I just what I want to, emphasize is just like there's also, a lot of opportunities when you come to that building wealth, being able to take loans and pay yourself back to buy another income producing asset. That's the thing.
Yes. That's the key.
That's the thing.
Income
we're
vehicle.
not taking it out to take a trip. We're not taking it out to redo our living rooms. We are buying an income producing asset. So you are getting, some real estate with that loan. So then you're paying yourself back with interest, much more attractive interest rates than you're going to get right out in the market. But then you also got this income producing asset, so whether it's stocks or whether it's real estate or, some other income producing asset. That's what you make sure you're doing.
Yep, that's part of the reason why I one of the criteria. So I ended up getting to a number of 25 stocks in my portfolio. I just thought that was a nice round number. One, it would allow me to spread out the allocations. So that I wasn't too heavy in one, and I could keep a workable percentage going into all of the stocks. So I didn't want to have a whole bunch that was like point something percent. I wanted to have, so all of my allocations, my highest is 7%, my lowest is 2%. Okay, so I have a lot, but what I settled on that number to kind of help me keep it in a workable amount. But I also wanted to make sure every one of them had growing dividends. They paid dividends and they paid consistently growing dividends over an extended period of time. So when you talk about the creating another income vehicle, this is a dividend snowball that will start to develop and accumulate over an extended period of time, so that in 5 years, 10 years, 20 years, however long the Lord allows me to stay on this earth, in a period of years, that snowball, because I've consistently been investing in those same companies over an extended period of time, that snowball will develop into $50 a month, $80 a month, $200 a month, $1,000 a month. And all I've done is invest in the same companies and allow them to keep paying me dividends, albeit small dividends, over a long period of time.
Yeah. And big on dividend reinvestment. Definitely. Yep. I mean, it's cyclical, right? Those dividends come in, you reinvest them. You're not having to worry about any fees because it's reinvesting on its own. And then what's it doing? You're getting more shares, which gets you more dividends. It just keeps going. It just keeps going. So I love that. I'm always big, I had a post a couple of days ago and I asked, which one of can any of your dividends pay any of your bills? And yeah, they can, but I don't use it for that. It's
right, just, absolutely not. Nope.
No, I'm not touching it, but it is good to know that, okay, what I'm shelling out for, my sewage bill each month, I'm getting that back in Vanguard dividends, each quarter. So that's a good trade-off.
I also wanted to add this though, because when I started, one of the things that tripped me up was I placed too much emphasis on dividends. So I was, at the very beginning, I was chasing a lot. Well, I started with when I discovered dividends, I started with the dividend aristocrats, which there's a list of companies who over an extended period of time have consistently raised their dividends every year in, year out, and they have a certain level of a market cap. And so everybody said, if you, I think the minimum is 10 years. You have to have raised your dividend for 10 years. So I said, okay, if these companies are good, so that's where I started. And then after investing in some of those, I realized that not all of them were actually appreciating in capital wise. And so I decided I needed to learn how to figure out healthier companies. So in doing so, I found out that a lot of the most profitable companies don't really pay big dividends. They keep investing more of their profits and earnings back into the development of their product, into the development of their company. Therefore, they don't pay really big dividends. So most of the companies that I invest in are a lot different than the companies I started investing in at the beginning that paid 5%, 6%, 7%, 8% sometimes. Now, most of the companies I invest in, even though they pay dividends, their dividends are like 0.6%, 0.53%, because I'm not concentrating on dividends. The dividends are just a secondary addition to the massive growth that is already taking place.
Yep, exactly. I think that's a trap that a lot of new investors fall into, because you're thinking about passive income, and passive income is such a buzzworthy term, and everybody wants to see that passive income. So they go out and get all these REITs, for example. REITs tend to have a higher dividend yield, but they're
very little appreciation.
Exactly. And their caveats, their tax as ordinary income.
Yep.
So that's something that a lot of people don't know. They think, oh, I'm getting all these dividends, but you're getting taxed as ordinary income. You're getting taxed in the year that it's coming in. So, making sure that if you do go the REITs approach, that you go with a covering, with a tax advantaged account.
Absolutely.
But yeah, people fall into the dividend trap. So I appreciate you bringing up that point, because I think that's a really good point. When it comes to new investors,
because in my opinion,
go ahead.
Your goal is to have your money grow, and it doesn't matter how that happens as long as the money is growing. And in most cases, the dividends are in the higher paying dividend companies. Their dividend might be getting higher, their stock price is also coming down. Yeah. So it's like they're giving you money on one side, but they're taking it away on the other side. So those high dividends don't end up really amounting to what you think they do.
Right. And in most cases, they're not sustainable, because if the company's not profitable, they're not going to continue to do that. So yeah. Well, Mark, I appreciate the conversation today. I think this was a really good conversation for us to definitely start talking about new investments.
I can't believe we've already been on there that long.
I know it's easy to talk about this stuff. We've talked about it before. It's easy to talk about this stuff for a while because it does excite us. So I appreciate you being here. I
appreciate you having me.
Yeah, absolutely. The last Monday of each month, we'll have Mark on to break down the market. Unless something too crazy happens, we'll have him on sooner.
Right.
But yeah, we'll just keep breaking down this market thing and getting our people the information that they need, and in hopes that they'll make that transition to sign on, to open that brokerage account and really start building wealth through investing.
Can I add one more thing? You mentioned it, but I didn't elaborate. You had mentioned about being able to just add. It doesn't take a lot of money to invest, and and that's one of the things that motivates me to share, because I don't make hundreds of thousands of dollars, and I invest a little bit here, a little bit there, a little bit here, a little bit there, but I'm consistent with my little bit.
Yes.
And I've just been consistent with my little bit over the span of the last 3 or 4 years, and I've learned how a little bit can turn into a lot if you just keep putting a little bit at a time.
I agree. Yep. I totally agree. And that's it. It's just got to start somewhere. So again, I appreciate you, Mark, and we will do this again soon.
I enjoyed it, and thank you again for having me.
No problem. You take care.
Have a good one.
Bye-bye.